Corporate Finance Presentation, Stock Dividend. Get ready, it's time to take our chance with corporate finance. Stock dividend. In prior presentations, we've been thinking about a company's dividend policy, the policy related to whether or not a company is going to be distributing dividends to the owners of the corporations, those being the stockholders or shareholders of the corporation, and if so, how much will the dividends be? Now, note that normally dividends can be distributed or are distributed with cash. They would be cash dividends, but that's not the only form of value that the corporations can provide to the owners. They could give value, for example, with stocks, issuing stocks to the current owners. Now, note, we want to keep separate in our mind the idea of a stock dividend and a stock split, which we'll talk about in future presentations. There is some overlap between the two concepts, but you want to keep them separate in your mind because they're treated typically differently. So we have the options, remember, of the dividend. So when you have the dividend policy or the options related to retained earnings, the two basic options we still have are, should we hold on to the earnings that we have generated within the company, or should we be distributing them then to the owners? If we hold on to them, then hopefully we're going to be generating a return on it. If we distribute the returns that we have to the owner in the form of dividends, they can use that and basically invest it in whatever option they would like. Now, once again, normally when you got the earnings that have been retained earnings represents the earnings that have accumulated in the company that have not yet been distributed. That does not necessarily mean cash that has been accumulated. That represents basically value. So you would think that normally when you pay out the dividend to the owners, it would be in cash. That would be the traditional kind of fashion, but it's possible to distribute something other in value, in this case, looking at the stock in terms of the stock dividend. So a stock dividend, the dividend paid to shareholders in the form of additional shares in the company instead of cash. So instead of getting cash, the shareholders, the owners of the company, will then be getting added stock. Stock dividends are not generally taxed until the shares granted are sold by their owner. That, of course, can be a benefit to the stockholders because they can get the benefit of the added stock and not have to pay taxes because it's not a cash dividend, which typically, of course, if you get a cash dividend, you have that information or that system of double taxation from the corporation, meaning the corporation is going to get taxed on income. The owner then gets taxed in the form of the dividend as income to them. So it could be a way to not really avoid or remove the taxes entirely, but possibly a way to give value and at least defer the amount of taxes that could be involved, given the fact that the owners would then have to generally sell the stocks that they got before they trigger the tax that would be impacted. Also note, there could be differences in the tax rates, as we saw in prior presentations, between the ordinary income, the corporate ordinary income, the dividend tax rate, and the capital gains tax rates, which could complicate the policy as to whether to have stock dividends or cash dividends and so on. So like stock splits, stock dividends dilute the share price, but as with cash dividends, they also do not affect the overall value of the company. So when we think about the stock splits, we'll talk about that in a future presentation where you basically have a 2-for-1 or 3-for-1 split. And that's going to be a little bit different than the dividend, which is usually going to be below the threshold. It usually is going to be kind of a percent breakout, but they're often around the 10%. And that's going to be treated typically differently from an accounting standpoint. And you could think conceptually have a different impact than the stock split will have. However, both will, of course, dilute the shares to some degree, because now you're going to have some more shares that are going to be out there, even though there's been no underlying change to the fundamentals of the company. In other words, assets and liabilities have not changed at all. The only thing that has changed is the number of ownership shares that are now out and has been distributed. The impact of that ownership shares to the owners of the company could differ if you're talking about a stock dividend, which is like 10% or somewhere around there, as opposed to a stock split, which you're basically saying all stocks are going to be 2-for-1. If you had one stock, it's now 2 stock and so on. But of course, the larger the distributions are after basically the 10%, they're going to have characteristics that are going to be similar to the split. So there's going to be, of course, overlap between the concepts of a stock dividend and basically a stock split. So a 10% stock dividend, if we just give a quick example, and the best way to understand these is, of course, to run examples. We do a lot of example problems on these, so you can take a look at those. We do them both in Excel and basically in just OneNote. So we have the 10% stock split. If this is where we stood before this is not a stock split, a stock dividend, 10% stock dividend. This is where we stand before the stock dividend, and we won't go into all the details here, but just a quick overview of the accounts that would be affected. This is going to be the statement of stockholders' equity portion, or the equity portion you can think of as the balance sheet or of the balance sheet, remembering that the accounting equation is assets equal liabilities plus equity, which can be reformatted as assets minus liabilities equal equity. So equity in total down here, this total equity represents, in essence, the book value of the corporation, what the corporation owns. The book value of the corporation, what the owner's claim are to the assets of the corporation, which are then broken out between these two components, the primary two components being the common stock and the retained earnings, common stock and additional paid-in capital and retained earnings. That's broken out basically between the amount of money that has been input into the company versus the amount of money that has been earned over the life of the company. So if we look at this where we stood before, we got the shares at the 4,000 before the stock split, 4,000 shares outstanding. The par value we're going to say is $5. The par value is not the market price. It is not the price that we sold or distributed the shares for. It's an arbitrary number giving us a nice play between the 20,000 and the 4,000 for the common stock and the shares, so that par value does not fluctuate over time unless, something like a split happens. And then the paid in capital represents the money that was distributed, or how much was paid to the company over and above the par value. Therefore, the 20,000 and the 5,000 represent basically the investment from the owners into, in essence, the company. The retained earnings represents the value of the earnings that have been earned over the life of the company, flowing through the income statement into basically the retained earnings, which have not yet been distributed to the owners in the form of dividends. That'll give us our total equity. Now, when we give out dividends that are normal dividends, cash dividends, we would expect the retained earnings to go down because they're not retained anymore and we're paying it back. The other side would go on the assets on the balance sheet, decreasing the assets, decreasing cash. But a stock dividend, and this is different than a stock split. A stock split will basically have an impact of only the shares and the par value up top, and we're not considering the retained earnings to change basically in a stock split. And this will become much more apparent if you practice problems with it. But the essence is that the stock dividend will basically be different in that we do expect there to be a decrease in the retained earnings. We are issuing value to the owners of the company by giving them the 10% stock dividend. So in essence, we'll have to determine the new shares that are going to be distributed. We're going to have to determine what the value of those shares are and reduce the retained earnings by the value that is being distributed. Now, the other side of this is not going to be on the assets. We're not decreasing cash. Instead, it's going to all be in the equity section. We're going to see what happens to the shares. The shares here are going to go up because there's going to be more shares outstanding. The par value will not change, so the par value will remain the same, but the shares will have gone up, and therefore the common stock will be impacted. It will go up, and then the difference between basically the change in the retained earnings and the change in the common stock that results is going to be what happens to the paid in capital, the change in the paid in capital in excess of par. So note we have an impact to all these components within the equity section, although the total equity section will remain the same. In other words, in this case, the 4,000 went to 4,400. The par value remained the same. Remember, that's different than a stock split where the par value will not remain the same. We had a change to the common stock due to the fact that the par value stayed the same, but the shares went up, and then the paid in capital also went up. This increase in the common stock and paid in capital is offset by the retained earnings that went down, which represents the value of the shares that were distributed from the company to the owner, resulting in the total equity then being the same. So the earnings per share decreased by the same percent shares outstanding increase, and the market value should remain unchanged. So if we run this through, and I won't do the calculations for the market value here, but we do practice problems in on it. This is what happens to the equity section. Then you might want to think, okay, what happens to the market value after this takes place? A little bit more complicated to think through, and that's why I'll leave it to the practice problems to work that out. But in essence, again, the earnings per share decreased by the same percent shares outstanding increase, and the market value should remain unchanged therefore. So the stock dividend and cash dividend, if cash dividend remains the same after a stock dividend, stockholders will get a larger total dividend due to the added stock. So in other words, if the company is paying a cash dividend and they have a set cash dividend and they don't change the cash dividend policy, and they then enter a stock dividend, increase in the amount of stocks that are out there. If you were an owner that had the stock before, and now you have more stocks due to the stock dividend that took place, and the cash dividend is the same per share of stock because it's the dividend per share, then you would think you might get more in terms of the dividends, because you're going to get more in terms of the dividends that are going to be distributed because you have more shares of stock if the dividend policy is on a per share basis. So in other words, the corporation doesn't really typically like to decrease the amount of dividends that are going out even on basically a per share basis. So if they increase basically the shares that are out there, meaning if I had one share, now I've got more than one share. If I have multiple shares, I have more than I had before, then I might then have an increase in the dividends due to the dividends possibly remaining the same per share. So when are stock dividends used? So they may be used if the company has a limited supply of liquid cash. So that's going to be one of the most common things. You might kind of still want the standard cash dividend. There might be some tax implications that could be involved as well, but they might say usually you'd like kind of the cash dividend. If they don't have the cash, if there's some kind of cash problem, then they might then issue the stock dividend. A stock dividend may be used to hide the inability to pay a cash dividend, and that could be seen as a negative. So corporations, of course, have to be kind of careful with the stock dividend strategy. It may be better, like if they're low on the cash and they want to give something to the owners, it might be better to give something like a stock dividend, but at the same time, it could be seen as an indication that they don't have the cash to be able to give the same amount of dividend, which could be a negative indicator on the market.